Hey guys, this is Steve Marshall with Marshall Real Estate in Boulder, Colorado, and making this video to try to give you an overview of cap rates. What are cap rates? A big question a lot of people have. So cap rate, simple equation, is basically cap rate equals the net operating income, NOI, over the value of the property, or the price. And so the classic example you see fairly often is $100,000 of net operating income divided by $1 million value gives you 10% cap rate. So knowing this, you can, knowing any two parts of the equation, you can always come up with the third. Obviously, if you know the net operating income and the cap rate, you can come up with the price or the value. And if you know the value of the property and multiply that by the cap rate, you can get the NOI, net operating income. So what is, besides that equation, what is a cap rate? It's basically an unleveraged rate of return. You don't have any loan on the property. It doesn't take loan into account. So it's a great yardstick for comparing different properties because you take financing out of the equation as well. If you use the cap rate as your required return, often they call that a discount rate, but if you're saying you want that 10% return and you find a property with $100,000 net income, you're going to pay $1 million and no more for that property. If the property's priced at 1.2, you would pass, or you would look for ways to increase that income to $120,000 to hit your 10% cap rate. Higher cap rate, it means a lower price, and a lower cap rate means a higher price, essentially. What things affect the cap rate? Well, there's tenant mix, amount of risk in the property, the market in general, vacancy rates on the property, location, leases, how strong the lease is, the length of the lease, things like that. Cap rate is a simple way of looking at things. That's why it's often the first measure that someone looks at when comparing properties. You can get into internal rate of return and cash on cash return. That typically brings financing into the equation. Sometimes there's multi-year analysis of the property. That's more complex, more complicated. You might want to get into that before you make the purchase, but for initial assessment of the value of a property, cap rate's a great way to go. Like I said, it's unleveraged, and that's generally a good thing to compare apples to apples with different properties. A rule of thumb when you're talking about financing, if your cap rate is 8% and you can get financing at 6%, generally your cash on cash return is going to be better than your unleveraged rate of return. So you can improve your returns by leveraging the property. If your cap rate is 6% and your financing is 8%, generally it's going to take down, a cash on cash return is going to be worse than an all cash deal on a property, unleveraged rate of return. So you got to take financing into account when you're looking at these properties. So if you want to buy a high cap rate property, high rate of return, maybe, but you have to remember cap rate or rate of return is also a measure of risk. So a higher cap rate property, while it's generally a better return, it's also a higher risk property if it's priced correctly. Whereas a lower cap rate indicates maybe a more stable property with a high quality tenant and a long-term lease. So you have to decide based on your investment criteria which type of cap rate you're going to want. Hope that gives you a basic overview of cap rates. If you have questions or comments, please leave them down below, and be interesting to see what you have to say. Thanks for watching.